The views and opinions expressed in this podcast do not necessarily reflect the views or positions of Acuma, its board of directors, its management staff, or its members. The podcast discussion presented is conversational in nature and for general information only.
Hello and welcome to Acuma's On Point Podcast, a series focused on sharing the stories of people who are making a positive impact in the credit union mortgage industry. I'm your host, Peter Benjamin. Today's episode is being brought to you by Housing Wire, a source for data, analytics, and media support the informed housing leader. My guest is Logan Mohtashami, lead analyst for Housing Wire. Logan, how are you doing today?
I am excellent. I am so glad I'm here because you are going to let Logan be unleashed and Sarah Wheeler is nowhere to be in sight. So I'm a happy camper.
This is true. This is the unabashed Logan that we never get otherwise. So really excited for this. Thank you for being here. I'm a fan and I'll dive into more of that in just a second. But before I do, really excited for this episode, but I need to pull back. Justin, what's the latest and greatest happening over at Acuma?
Hey, Peter, how's it going?
Living it.
So we have a lot going on. We just got back from our summit in Phoenix. Time is like it was yesterday. We just got back from our summit in Phoenix yesterday, and that was an amazing summit. We had crazy interactions with engagement, and the roundtable discussion was just off the charts. Coming up in the near future, we have our workshop in May, which is going to be in Nashville. So if you didn't make it out to the summit, come and see us at one of our workshops. If you can't come to Nashville, we'll be in Denver in June. And then we have our annual conference in Las Vegas this year, which will start in September and end in October. It's one of those fun 2-month ones. And then beyond our in-person events, we have a ton of virtual events. So we have our Inside Tracks, Fast Tracks, Young Professional Network, our On Point podcast, obviously, but tons of ways for you to take in the education and really engage with the Acuma team.
You know, Justin, Ginkgo biloba will help with that memory. Apparently you had a lot of fun down in Phoenix because you couldn't remember where you were.
You know, it's something about that desert sun just kind of fried my brain a little bit. I'm not used to it on the East Coast.
Yeah. Okay. Mm-hmm. Okay. No, it's good. That's good. Thank you, Justin. Appreciate it. Excited for all the fun events, amazing events we have coming up through the rest of the year for Acuma. All right, Logan, let's turn back to you. All right, so like I said, I'm a fan. I feel like I welcome you into my office almost on actually a couple times a week. I listen. I get your emails. I listen to the podcast, so I'm a big fan. I've talked about this in the past with other experts that we have on. There tends to be just, the daily routines that you do to kind of keep up to speed, up to date on the things that impact our day to day. Whether it's the economy, whether it's policy, there's just certain things that you do. You happen to be one of those things for me. So I'm really excited to have a sit down with you. Now, I may bother you. I may, pick your brain about, where you anticipate or think about where our economy is heading, or at least housing is heading. But I want to stay true to the On Point podcast. The On Point podcast is really focused on you as a person, right? Now you take a different perspective than a lot of other analysts to housing, really what's happening in our housing market. And I kind of want to peel back the layer on that, figure out why. Why do you take this different approach to how we do things, right? So first off, I haven't asked, you've gone down this approach. You take a different approach, but how did this start? Like what kind of started as the backbone for Logan becoming Logan? I mean, I've heard the story about, your namesake, but maybe if you want to share with the Acuma On Point podcast listeners, let's go down this path of who Logan is.
Well, I think my parents met in 1973. But to make it shorter, of course, our family's been in banking since the late 1950s. My father opened up his own mortgage company after being a branch president of Bank of America for different cities. And I kind of got into the stock market in 1996. My whole intention was actually to be a high school basketball coach and teach history. in the late 1990s. That was my whole thing. So when I got into the stock market, I was like, okay, this is fun. And then I joined the family business, and I was a loan officer for about 17 years. I retired early 2020. But around 2010, this gentleman, Jason Resnick, who writes for Benzinga, he saw me debating Michelle Cabrera, who's the CNBC anchor on political economic theory. And he said, do you want to write politics for us? I said, hell no. Politics is the word itself. Politics, many blood-sucking parasites. That's not my thing. But I'll write about real estate. I can do that. So I thought that, there's a lot of things on the credit side that was not being accounted for properly, just because I think economists or media people, they're not trained in this and they don't have that kind of experience. So I thought, okay, let's do this. And let's just, write casual, references to the housing market. So that's how it all started. It was a freak accident. I had no intention whatsoever to do this. Then what occurred is the athlete in me, and this was the key to everything. About 2013, 2014, I realized a lot of the stuff on the internet's trash. I mean, it's really just trash. I mean, it's just very doomsday-ish, and it gets a lot of attention. So I thought to myself, should I just change how I do things and not only talk about the housing market, but actually talk it as a data analyst and actually talk about the economic cycles first and then go into housing? And this way we can create models for people to follow, because it really was a lot of trash stuff in the last decade. So by 2015, I started to change how I talk about housing and the economy, incorporate charts and make this more of a data analytical approach to bond markets, demographics, everything credit. And so it kind of took its life of its own. And then what occurred was in the last decade, everyone's calling for a recession every 7 minutes. Everybody wants to get attention by calling a recession. Everybody wants to talk about a housing price crash, right? As I call it, the documentation of the housing bubble boys 2.0. These are mostly people who hate the Federal Reserve and are just always bears. So it was a whole process to show people how to look at economic data properly, which if economics is done right, it's boring. It's not really designed to be this hot, fun, sexy thing. It's just trend lines and data lines and trying to get people versed. But Housing Wire at the end of 2019 asked me if I wanted to write for them. At first, I was kind of hesitant. I was like, no, do I really want to do this? I have my own thing. But I said, okay, it's years 2020 to 2024. For those who don't know me, the previous decade, I said we'd have the weakest housing recovery ever. We have to work our household formation all the way up to years 2020 to 2024. At that time, things will be different. Here's 2020, ready to go. Housing broke out, the first few weeks like it should have. Everything looked great. And then COVID happened. So at that point, I think what people knew me back then, because my audience was much bigger because of Housing Wire, I literally wrote a COVID-19 recovery model on April 7th, 2020. There was a bunch of things in there that happened on that day. And I was like, okay, we're going to recover this year. So Housing Wire at first, Sarah Wheeler was like, do we really want to publish this? Because this guy's new to us and he's basically saying we're recovering in 2020. And I was like putting dates and data lines and everything. It's like, yeah. So mad Dr. Frankenstein in me is ready to go. And everything worked perfectly. We actually retired the model on December 9th, 2020. Then I think the scope of my work got bigger because people realized there's an economic side and then there's a housing side. Mm-hmm. And then it was like every single year, home prices are going to crash. And then trying to teach people how to track stuff daily and weekly and look at forward-looking models, which I could see in the past 12 years, before even 2022 happened, that people just weren't versed in it. So my job is just to really connect the dots. But it really started with like the athlete in me who wants to win. Like all these people want to look good and lose. Like me, I just want to win. I don't want to be wrong. I just don't want to be as bad as these people. So that's the motivation of every single day. Think of me as a strong safety in football. And I see an overrated tight end who talks a lot of trash coming down the field. I want to knock him on his ass in front of everyone. So everybody knows this guy is soft. He's never right. He's going to say the same thing over and over again. And this is the new thing that I've done after 2022. So 2022, we had the biggest home sale crash ever recorded in history. My affordability models were just broken by March of 2022. So that wasn't surprising, but everybody went into the price crash. So I was literally challenging every human being to a live camera debate. That's my thing. If I could get them on camera, I could smoke them all out. But only a few people, crazy enough, took me. It didn't end well for them. But this way, in this society we live in, people like optics. They like a show. Now, the core root of me, I'm that old guy 500 years ago in a dungeon with a candle reading like old text. That's who I am always. But in this society, if you want to teach people, right, the historian, the basketball coach in me, you've got to get people to listen and you've got to take the other people out. So there's where I'm a little bit different than everyone, because I will challenge any human being on planet Earth to a live debate. And what I want them to
So sorry, it's interesting because thank you for sharing all that. But part of it, I'm fascinated the fact that you possibly could have been a history professor. Because you share that a lot. You share the history of things a lot in your analytics, and even in the podcast in your podcast that you record. That goes into a lot of the things that you do, and that goes into a lot of the things that you share with your audience, your analytics, and how you approach housing in general. At the same time, you're right, 100%. I can't tell you how many times I say I will challenge anybody to a contest live streamed of who's going to be right. So I sense the passionate athlete in you and how much you care about being right, which is absolutely fascinating. Absolutely fascinating. Now, have there been times that you've been wrong?
Every analyst is wrong every single year. Every model has to be worked off of variables that change, and that's how you create your own models in a channel. Like, here's a good example. Last year, I said if mortgage rates get above 7.25%, the inventory growth rate should be between 11 to 17,000 every single week. And not every single week, but we should get a few weeks where the growth rate of inventory should be higher, because I'm not a mortgage rate lockdown person, but higher rates and more inventory growth, days on markets grow. That did not happen one time last year, even with mortgage rates getting toward 8%. So what that does is you're looking at something and you're saying, okay, this is not happening. What is it telling me? And I think the story of 2023 was the one thing nobody talked about. Mortgage rates were heading toward 8% for many weeks, and the price cut percentage data was still negative year over year the entire time. Nobody ever talked about this. I wrote it on the tracker. I'm like, does anybody care about what this is saying? So as an analyst that creates models, you have to be wrong. There's no way you can be perfectly right if you create your own models, because things deviate. And I always say that economics is not static. Things change all the time. You have to go with the change, because being wrong shows you what the data is trying to tell you that you got incorrect, and then you adjust off it. What happens in this country a lot is that everybody's wrong with recession calls, but nobody wants to look at why. That's why the why aspect is really important to me. So we do these forecasts, but I always say that a forecast is useless if you just say something and let it go. And this is why I say that we track things weekly to look ahead, because things change like this, and you don't want to be old and slow. I always say, but being old and slow is bad, because 500 years ago, it didn't matter. You would send dispatch horses out to get information in another country. 9 months later, those horses would come back to you and say, oh, by the way, you're about to get invaded by the Spanish Armada. We don't do that anymore. We got the internet. Things move faster, so you have to move fast with it. So you have to be religiously following everything 24/7. That's the advantage I have over everyone. I don't know how many housing people actually religiously follow all economic data 24/7. I don't sleep much. I track everything, because if something turns, you got to turn with it. That's the adaptability. That's why forecasting, you have to be wrong. Nothing is perfect, especially if you track stuff daily. But this way you can show people, like, I want to show the why. Like, the why and the how are so important to me more than the final answer. Because if you can teach a country to read, like, my thing is that reading is a good thing, right? The history of human civilization has taught us those that read have an advantage over those that don't read. Well, guess what? Literacy rates have exploded in the world in the last 200 years, but reading is down in America for decades. So people are susceptible to fanatical takes on the economic side because it's sexier. It's, oh yeah, crash, boom, destroy. So there has to be a group of people that combat this. Now, unfortunately, the academic world doesn't have the personality for this, right? They tend to block people and ignore and all that stuff. Me on the other
enter Logan.
Yeah, me on the other hand, oh hell no. We are throwing down, but we are doing this on camera. Because once I get them on camera, I'm going to ask them for their forecast and they're going to say, we don't do that. I go, really? No, duh. Okay, do you have any forward-looking models? No, I just say this and it's great. Of course. So people have kind of caught on to my act because like Unleash Logan, like I have shown mercy to a lot of crash people, a lot of recession people. Like if I ever wanted to really go with Logan, I would destroy these people's credibility. So what's occurred right now is people are starting to withdraw back. And that's one of the things I wanted to do. I wanted to take that sword and circle around me and go, if you guys ever want to come back in here again, we're debating and they've learned their lesson. So I think that this was all a strategic tactic on my part, because in this day and age, you have to do something to catch people's attention. So what's better than challenging everybody? I mean, we're all humans, man. If a man says this and another man says, oh, let's go have a debate. And the other guy goes, no, I don't want to do it. And everyone's going to go, hey, you don't want to. So I got the response I wanted. Everyone is kind of backing off. Even some of the crazier YouTube people in this country, like people are trying to get him to debate. And they're like, no.
So it's interesting because, like, I mean, you approach this differently, right? It's almost like, I am Logan. This is who I am. I'm going to be authentic to myself, right? And I'm going to present my analysis the way of who I am, right? And at the same exact time, again, I read housing data daily, right? Oftentimes it's just in a single email, and that email contains a chart. It doesn't properly explain the history, the why, what it actually means, how it impacts me, a good forecast. It doesn't contain any of that, right? Whereas you're explaining that why. You are providing the data points that help me understand from a different perspective as to what this forecast actually means to me and what I can actually expect for our industry, or hope to expect for our industry, good, bad, and anywhere in between. So I think it's fascinating, but you're right. I mean, it's you definitely take a different perspective than a lot of other people on YouTube, Twitter, you name it. And it just fascinates me because your different perspective almost tends to be right in many ways.
Because I talk about it how it's properly should, right? And if you talk about economics in a proper way, it's really not that exciting because it's trend lines. It's data that will show people a pathway. And the problem with showing people the pathway is that if everyone reads it, then everyone has the same information and everyone knows what they're doing. This negates the extreme takes on either side of the economic discussion, right? This is why the historian in me likes to use historical jobless claims data to trigger a recession call. And that's why I would say, right? Like we have not even triggered one labor recession call outside of COVID, right? And outside of that, this means that we had the longest economic and job expansion ever recorded in history after 2010. Without COVID, we wouldn't had that recession, but every recession call was wrong. But it's not the call, it's showing people why. If you show people why, it negates the fanatical takes, because that means people read and they understand. And then the worst thing to happen for people is an educated society that reads. Then it's like, wait a second, you're wrong, dude. You vote. Yeah. And so I think what's occurred, what I wanted to do is give people an outlet. And this is why I always say, like, I tell people, if you really want to follow nerdy, my Instagram stories, like everyone's having fun and going out and on vacations and smiling and drinking. My Instagram stories is looking after all the economic data in the day, right? So it's not designed for fun, but it's designed to teach. And that's the high school basketball coach of me saying that the fundamentals matter more than a trick play that could score one basket. I've got to get you to learn how to play team offense and team defense, because that's 95% of the game. If I can teach people how to read economic data correctly, that's 95% of the conversation. I get that 5%. I could take that 5% out any day. That's that weak tight end that's talking a lot. I'm going to knock him on his ass. Game's over. He's not coming down the middle anymore. But I can get a whole country to come with me. And that's the whole point of it. So the academic world just doesn't have the personalities to do this, nor do they have the time. Me, I am fortunate because I retired. I was like, game is on. I can do this 24/7. And with this kind of focus and determination to always want to win, I don't think there's a lot of people out there that want any of this. And that's the thing. It was all designed to get people to read. And so far, it's especially in the last 18 months, because after 2022, everybody went home price crash mode. And you can see this. You have the biggest home sale crash ever. So because I track weekly data, I said, guys, November 9th, home sales are going to get down to a certain level. We don't really go below that historically. And if rates fall, we always see a bounce in demand. The market is going to change. That's what occurred, but it took people 6 to 7 months to finally get that. And now I think everyone's like, oh God, guess what? The 10-year yield fell again. Mortgage rates are growing out. Do you want to make the same mistake again? Because Logan's going to burn me. And that it was all designed for that, to let people know that you can do your stuff, I can do my stuff, but if you're going to come in this area, you got to be careful, right? So that's the whole point, was to teach economics. But in this day and age, you have to teach it in a way that people want to listen and hear. And you have to put a bit of the theatrics in it, or else you're going to be like, when I do these nerd tours, I try to make it as lively and fun, as energetic as possible. But I've realized that my economic friends are like, they're talking very structured, because people say, oh man, it's the things I listen to past are so boring. So the trick is finding a way to make it as entertaining as possible, but be as educational as possible, but be as simple and understandable. And I think I found the Elixir magic on that, just to get many points across and give people something to work with going out in the future.
Now, I'm fascinated by this, because I've asked this a lot to housing analysts, and I never really get a straight answer. So I'm gonna ask you, right? I'm gonna talk our members up. Our members, our listeners, have a thirst for knowledge. One of the reasons why you're here, you're sitting with us on our podcast, is that a little teaser for our annual conference, and you're one of our keynote speakers at our annual conference, and we picked you because of your passion for this, right? Now, thinking about our members, right? Our members have that same passion. They have a thirst for knowledge. I think when you come to our annual event and you're surrounded by our members, you're really going to see that, hey, they're very inquisitive. They ask a lot of questions. They really want to understand my analysis. They want to understand who I am. Now, again, this is the question that I always ask to people, any housing analyst, and never really get a straight answer. If one of our members wants to understand this better because they're very inquisitive, what are the metrics? What are the data points? 10-year bond aside, right? That's mortgage 101. What are the data points that they should be watching that may call to them, hey, this is a red flag, this is a positive, whatever. Doesn't really matter. What are those data points that they really should be focused on that will tell them the direction of our market? So
we created a tracker article at the end of 2022.
Comes out every weekend.
It comes out every weekend. It is a forward-looking model. It's a forward-looking model of mine, and it has been flawless since the Peloponnesian War. That's how I go with it. And what it does is, we're talking about the housing market. So the tracker article, because we have Altos Research now, Altos Research and Housing Wire joined forces, I have all the weekly inventory data. It's not fair. It is not fair that I have access to this information, because on top, that was the last piece of the puzzle for me, because I can incorporate a live weekly inventory data. Because what happens is that existing home sales and a lot of sales data is old. We want to look forward. So in the tracker article, we have this list that we follow, and I go through everything on the weekend, and then we talk about what's going to happen in the week. So we have active inventory. These are the homes that are available for sale. Just to give people some perspective, in 2022, March of 2022, we only had 240,000 single-family homes available for sale. That was it. In a country of 157 million people working in 335 million. That's it. That was the level. Then we talk about new listings. How many homes are coming onto the market that don't have an offer? That's the new listings count. This is the one that, if you go back in history, you could realize what happened in 2008 to 2011 and the new listings data currently. The interesting aspect is when we go back in the history of economics, maybe 100 years from now, they'll come back and go, it's really interesting that people thought inventory was going to skyrocket, even though new listings data in 2021, 2022, and 2023 were trending at the lowest levels ever recorded in history. It was there. I just don't think a lot of people knew it. So we have active inventory, new listings data, but we also have price cut percentages, right? And one of the things I found out that was new to me is that the country didn't know that 1/3 of all homes have price cuts. Always. That's very normal. So the gimmick that people use to try to trick people that home prices are crashing is they'll take a snapshot of Zillow or Redfin and go, oh, look at these. 1/3 of all homes have price cuts. So the price cut percentage, the slope of that curve went higher when we had 2022 home sales crash. And then it stopped. It stopped. The slope stopped. It went very normal. In fact, this year, if the trend continues, we're going to have lower price cut data than 2023. So that's the inventory side. We can't miss it because it's new. Other people are waiting like 2-3 months to get the inventory data. We have it fresh. It looks out. And there's also 60 other data lines that go with that Altos research that we don't share with the public. And Mike Simonson, they can actually go through every single zip code, and there's a ton of other stuff that go with it, like, pending listings, list price, everything. I only try to give people the general macro US version to give people a heads up. Then we talk about purchase application data. Purchase application data moves with the 10-year yield. It's a trend survey. It's not the best on percentages of purchase apps versus percentage of sales, but it's a trend survey. It looks out 30 to 90 days. So after 2010, the entire US economy and housing market changed after 2010 because of qualified mortgage. Whenever the 10-year yield goes up, rates go up, purchase application data falls. Whenever the 10-year yield goes down, purchase application rises. It's that equilibrium between those levels. So we have active new percentage cuts. Then we talk about purchase application data as we do year-to-date counts to give people perspective. Nobody else does that. Mm-hmm. Because I literally recorded on paper to make sure that I get every single data line for years so we can back test stuff. And then the final thing is mortgage rates, 10-year yield. But what drives the mortgage rates? I always say the slow dance, right? There's a slow dance between the 10-year yield and 30-year mortgage rates going back since 1971. They are love partners. They love this. Sometimes the spreads are very wide, so they're slow dancing apart, and sometimes they're close to each other. Right now, the spreads are historically high, but what drives the 10-year yield is what drives mortgage rates, economic growth, inflation expectations. This is where it gets very tricky. And this is where I take pride in my work. I always do yearly forecasts on 10-year yield ranges, and we work off of that. Just for 2022 and 2023 and 2024, talk about we should be in a range between 4.25 and 3.21. We have a line in the sand that I don't think we're going to break. So last year, I think the big call for me is that a lot of people thought mortgage rates were going to fall because the growth rate of inflation fall. It doesn't necessarily work like that one-to-one. Global bond yield. I brought Gandalf the Grey. I thought everybody knows you shall not pass. Now, everybody was like, here comes the recession, here comes the rates. I literally kept on pushing videos of Gandalf the Grey. I said, we're not going to break this level. We're not going to break. Here's a banking crisis. I'm like, oh God, we broke it for one day and then we shot up because the economic data. So my job is to try to explain where the 10-year yield ranges and where mortgage rate is. We put them all together. And then at the bottom of the tracker, we talk what's coming out of the week, is retail sales, jobless claims, job openings, and try to give people a perspective. This way, we all hold each other's hands, and 24/7, I am not going to abandon you. I'm not going to be that person that does a yearly forecast and you don't hear or see that person for 4 or 5 months. 24/7, all day, all night, we will be there because things could change like this and you don't want to be old and slow. And that tracker is designed so everybody could read it. And then all of a sudden, as people started to read the tracker, they look back and go, wow, it really does work this way. So it's designed to look ahead, not in the past. So a lot of people are still waiting on old stale data. We believe in looking at the current and the future. And this way, everybody is ahead of the curve. That's the job, to be ahead of the curve. And I believe this model has worked. You could back test it, every single thing. It does that. And then what we do is where other people don't want to do for housing is talk about the economic cycle itself. And that's my key. I'm an economic cycle person first, housing second. And then we put the enchilada of all the data lines together. And then this way we could talk about housing in a more coherent way, but also hold your hand and we're in it together 24/7. We will not leave you at all, any day or any night.
That's good. That's great. Now, Logan, I could honestly listen to you talk and really dive into this a bit more but we have to start pivoting to the second segment of our podcast. But before we do that, one question: 2024. Do we see interest rates in the 5s? Yes or no?
Under sub 6%, yes. Under 5, you're going to need a recession for that.
Okay, I'll take sub 6. I'll take sub 6. I'll take some.
I've got my range for this year is 5.75 to 7.25. The 10-year yield between 4.25 and 3.21. The Gandalf line is still there at 3.37. The thing about this is that the spreads have the potential to go down. See, I don't think the Fed pivoted. This is where I'm a lot different than other people. People think the Fed has pivoted. No, they are extremely restrictive today. I'm about to go on CNBC in 30 minutes. I'm about to bash the Fed. It's like they're still stuck in the 1970s, and it's not the case, right? So they overhiked, and because they overhiked, all they're doing is taking a few of their rate cuts back, but they're restrictive on their own model they told us to follow. So this is why if the Fed changes their tune, then we can get sub 5% mortgage rates, especially if the labor data gets softer. But for some reason, they're still stuck in a period of time that doesn't relate to the current market. And again, the history of global pandemics, I always talk about this. It's very inflationary, like war, right? Supply chains don't work. Yeah, people always said, well, the U.S. printed so much money and everything. Listen, there's inflation in Japan. Mm-hmm. Japan couldn't create inflation if their life depended on it. 40% of their population will be dead at the end of the century. There's inflation in Europe still because nothing has to do with us getting $1,200 checks, right? The global pandemics are always inflationary. Then the disinflation happens. And of course, rent lags badly. So we're already kind of there already, but they're still very restrictive. So I can go below 5.75 if the spreads get better. But to me, again, jobless claims. If jobless claims today, as we're talking, headline jobless claims under 200,000. If we go back in the history of U.S. economics post-World War II, that is a historic number. If that number's at 300,000, we're fighting that Gandalf line and people are talking about recession. The bond market won't wait for the Fed at that point.
So 5.75, you and I both know that's a big difference. And that potentially could make a big difference between current volume levels and potential volume levels. You always say it, sellers or buyers, right? At the same exact time, at 5.75 starts to open the door to refinances as well. And that could turn around that could make 2024 most certainly a better year than 23 and most certainly a better year than 2022. So
we should have a better year than 2023 just because the growth rate of inflation has fallen enough to where the 10-year yield can go lower and stay there. The unfortunate aspect of 2023 was that we had mortgage rates at 6%. And Neil Kashkari, the Fed, had to come on TV and said, you guys are making it hard for us. The housing market, people are buying homes, having sex, creating households. That makes our job harder. Boo-hoo. This is why I say it's a COVID-19 policy, right? First of all, home prices don't even run into your inflation data. That's not how you even model it out. And you're like, oh my God, 6% rates. That makes it bad. Oh, that really pissed me off so much.
We could tell.
Oh my God. If I ever had a one-on-one with one Fed president, it's him. Because he's not a baby boomer. I understand why Powell might think this or Waller. They lived in the 70s. You basically my age. We're kids. We're watching He-Man and Spider-Man as cartoons. Come on. He has nothing to worry about this. So
there you go.
We can get rates lower. I'm hoping that throughout the year as it goes on, the Fed becomes more dovish. We're already seeing some positive things on them kind of making sure the quantitative tightening goes a little bit slower. I mean, listen, if the Fed wanted to snap their fingers, they change everything.
There you go.
They can change everything they want. They choose not to because of some devotion to some 1970s models that does not exist. And just to give everyone perspective, for us to get the 1970s inflation, oil needs to be at $450. That's what needs to happen. And we are producing a lot of oil here in America. Go look at the oil production numbers. We are smoking Saudi Arabia and Russia, right? So things are a little bit different now. And hopefully, as the year progresses on, I'm hoping, I hate to hope, but I'm hoping that the Fed just starts to get a little bit more dovish as time goes by.
There you go. All right, fantastic. All right. Well, it's time to pivot. And so, in the second segment of the On Point podcast, we tend to focus on things like trivia, Jeopardy. Every once in a while, we play a fun ranking game. But today we get to do the crowd favorite of dad jokes. This segment, the dad joke segment, is probably the number one requested segment for us to do in the podcast. So we're fortunate enough to have you participate in the dad joke segment. So here's what we'll do. We prior to recording today's podcast, I asked you to come prepared with 2 to 3 dad jokes. And so we'll just go in order. We'll just share them. So Logan, since you're our guest, you get to go first with your 2 to 3 dad jokes. Then Justin, then I'll wrap up and then we'll close out. Sound good?
Sounds good.
All right. After you, whenever you're ready.
Why is the Fed old and slow?
Why?
Because they were born before 79. Every baby boomer in America is old and slow because look at their age. So my dad joke is that we're asking people who can't run a 440 to be fast.
440.
Because they are old. So let's get Powell, let's get Waller, let's get Messenger, let's get all of them and put them on a track.
Okay.
And let's see how fast they run.
No, I don't know. I'm not old, but I don't think I can run a 440.
Let me get them all on a track. And then I could tell they're old and slow for a reason because they're old.
Okay.
And they're slow. And so we want to keep on focusing on that. So we are young and we don't want to wait. The old linger while the young suffer because of some devotion to something that's not there.
Okay, very good. All right, do you have another number two? Number 2.
I think I might have already talked about this, but why do I hate politics?
By the way, this was my favorite line in the entire episode.
There's Justin. There's Justin.
So let's think about it. It's right in front of us. It's right in front of us. Ticks, many blood-sucking parasites. It is literally in front of us this entire time, and we wonder why politics is crazy. They're ticks.
There you go.
There are many ticks everywhere.
Thank you very much. All right, so Justin.
Mine are not going to be economic or Fed related by any means.
There you go. But hey.
But we'll stick with some of the themes that we heard in the episode today. So, parallel lines have so much in common, right? But it's a shame they'll never meet. There you go. Goes with that trend line thought, right? And then something that I think is very important is being detail oriented. So anybody know what the most detail oriented ocean is? It's the Pacific.
Oh, I hate that I like that so much. I hate that I like that. I do.
Had to keep a little bit on theme here.
No, but the funny thing is, so Logan, I often talk about my kids, right? I have 3 young kids. I have a boy. My oldest is 6, and I have twin girls that are 4. And my boys, my son still very much talks, like a little kid. Has a hard time pronouncing stuff. But just the other day, he instead of saying Pacific, he said the Pacific Ocean, and I was like, so good one, Justin. Good one. So, anyways.
I mean, it's good that he got that wrong the other way. Most people get it wrong because they can't say specific.
That is true.
So,
this is true.
I mean, that's an upside for you. That's like a win.
I guess. All right. So my turn. So this kind of stays in line with, I guess, Logan's first joke. So I was at the liquor store the other day, and the clerk asked for my ID. But then my Blockbuster card accidentally fell out of my wallet, and the liquor store clerk said, "Never mind."
And all the crickets are going, "What's Blockbuster again?"
Whatever, dude. You know what a Blockbuster is.
Of course I do.
There's one Blockbuster left.
One Blockbuster left.
Yeah.
Did they make a movie about that?
I mean, they made a movie about Blockbuster.
No, I think they made a movie about the last Blockbuster still standing, or it was a documentary or something like that.
By the way, I think Blockbuster could have bought Netflix.
Yeah, they had the opportunity to buy Netflix, and they turned it down.
They turned it down. It's like Yahoo
because they said that nobody was ever going to go to streaming or renting DVDs by mail.
It was like Yahoo was going to buy Facebook, but then they thought, so.
It's that hindsight's always 2020, right? I mean, so it's like.
This is why you don't want to be old and slow.
This is right.
Look for the future.
All right. My last joke. Why did Billy get fired from the banana factory? He kept throwing away all the bent ones. All right. Our listeners can't hear it, but Justin and Logan are laughing at that one. But it's okay. It's okay. All right. So
can I tell you one more about soap?
Sure.
Okay. Never mind. It slipped away.
What? You know what? There you go.
There you go.
There you go.
Did you hear the rumor? Did you hear the rumor about butter? Well, I'm not going to spread it.
Speaking of which, if you want to know a personal story of mine, when I was younger, I did some acting, and one commercial that I almost got on was a Snickers commercial. Okay, you guys know the Snicker commercial where you're, going to be here for a while, have a Snickers.
Yeah.
So this is the 1990s, and I'm an NBA professional basketball player that's a rookie. And I go into the shower and I'm talking all this trash. Imagine me. Imagine that's the role they want me to play. So here they are, and all of a sudden the bar of soap falls. And then I look at the old guys and I go, hey, you guys pick it up. And then the old players say, no, you pick it up, rookie. No, you pick it up. And the guy pulls out a Snicker and says, going to be here for a while. So that was actually, there was the final two commercial. It was on Vail, but they deemed it to be too racy. And this is the 1990s still. So
anything went back in the 90s.
Yes. So that thankfully, there's only one commercial I did, and I know that there's no technology that anybody can see it. But that was a previous life.
That's
back
awesome.
in the previous century.
That's awesome. That's awesome.
Funny.
Well, Logan, thank you very much for being on today's podcast. I really do appreciate it. Enjoyed the conversation. Enjoyed learning a little bit more about you and how you approach housing and analytics. Again, thank you very much.
My pleasure. And always remember, I'm a strong safety, and I'm looking for that tight end to come down the middle.
There you go. There you go. And thank you to Housing Wire for sponsoring today's episode. Without your generous support, we would not be able to bring such amazing content to our members. And to everyone else listening, thank you very much for taking time out of your busy schedule to listen to today's podcast. We know that you're busy, and we appreciate you just chiming in. Until next time, everyone, take care, and we'll see you next time.
Thanks for listening. We'll see you next time at the Acuma On Point podcast. If not already, be sure to subscribe and give us a 5-star rating. For more great episodes and information, be sure to visit us online at acuma.org. And to get the latest updates, head over to our LinkedIn page.